Good afternoon and welcome to our third installment of Lunch with GoalsGetter series. Really thrilled today to be able to bring you two portfolio managers of probably our two most popular funds. We have Dan Frost, who's the portfolio manager of the Focused Growth Fund at Generate, and Jonathan Windust, who is the portfolio manager of the Active Growth Fund at Milford. Before we jump into things, I just want to mention a couple things that have been going on in GoalsGetter land. Our app is now live, so we sent out an email last week. Please share that with clients. Log in, test it out, let us know if there are any glitches. We're going to go to market with it publicly later this month, so would really love any and all feedback you have on that, but hopefully your clients are enjoying having that application on their phones. The second thing is that our fund manager pages have gone live. So we have a page dedicated to each of the 6 fund managers, telling a little bit about who they are and what they do. And then each portfolio manager has also created a video on each of the 18 funds that we have in GoalsGetter KiwiSaver. So please do log on and check those out. The final thing I'll mention is that please do save the date. The 15th of May, we have reserved a place at the Alcott, which is just across from our office on Shortland Street here in Auckland. So for any accredited advisors in town, we're going to have just some cocktails with the portfolio managers, distribution teams of all the fund managers just coming together and celebrating our 1-year anniversary of the GoalsGetter KiwiSaver scheme. Now, I'll stop talking and hand it over to Dan Frost now. There's been a little bit of news in the markets lately, so it'll be great to hear your perspective on this, and then maybe just to hear how you're managing things in the fund. Dan, are you there you go.
Great, thanks, Katie, and good afternoon, everyone. I appreciate you taking the time out of your busy days to listen to me talk about Generate and the Focused Growth Fund. We're really excited to be on the platform, and so appreciate this opportunity. I'll start off and I'll talk about Generate and just introduce the business. I'll talk a bit about our investment team before moving into our approach, and then what probably everyone's after at the moment, our current positioning and how we're reading the environment. So Generate was founded in 2012. We started taking cash from our clients in the second quarter of 2013. So it's a relatively young business, but we've grown strongly. We've currently got just under 7 billion of funds under management across 160,000 clients. When I joined 7 years ago, we only had 700 million in funds under management and have grown obviously 10 times that number in just 7 years. There's two things that we focus on at Generate. One is returns and performance. We're a performance-orientated culture, and we make no excuses about that. Secondly, we're focused on customer service, and that's why our customer service awards feature so prominently in our marketing materials and offering docs. I'm hoping that I can change the slide. There we go. You can see there, we've got a couple of awards at the bottom of this slide. Before going into detail, I'll just give you a couple of highlights from the investment team. The first is that it's been remarkably stable. There's only been one departure since inception, and that happened in 2017. Sam hired someone that wasn't a right fit for the organisation, so they didn't even make it through the probation period. When I got hired in 2018, they'd certainly learnt their lessons, because I got interviewed by everyone. Even the board had a go at me before they hired me. The second thing I'd like to note is that our team has grown quite rapidly. In the last 4 years, it's doubled, and we're currently hiring for 3 new roles. And so the team is really scaling up with the funds under management. Now, going into a little bit of detail on the team, on the right-hand side of the chart, the right half of the chart, is our global equity team. So you've got the equity analysts, Natalia and Dan Kluter. They work for the 2 global PMs, Nathan Field, who operates out of our Auckland office, and Warwick Simons. Now, Warwick technically does not work for Generate. He works for Compound Global Advisors. He's located in Seattle, and we use him on a sub-manager basis for the Global Direct Fund. He uses our equity analysts. He is involved in our team meetings, contributes to asset allocation. So you can sort of get a feel for the fact he's an integral part of the effort. Finally, we've got Sam Goldwater. He looks after the managers fund, which contains the external managers. Sam's one of the two co-founders, of Generate. And so he has been looking after the investment operation from day dot. If we now move to the left-hand side, moving first to Australasian equities, you can see there that myself and Andy look after Australasian equities. We do that on a joint basis. We go to the same meetings, we travel to the same places, we meet the same analysts, we swap research, and so we have the same knowledge level. And what that allows us to do is really debate how we can best improve the quality of the portfolio, where we should be trading. And so it's a constant discussion that we're having through time. Fixed income is next left. I won't spend too much time on that because focused growth doesn't have a big allocation. Sustainability, Stella is a new hire. Sustainability at Generate hasn't changed too much over the last 5 years. We've just added a lot more sophistication. We started off with the view that ESG and sustainability needed to enhance risk-adjusted returns. Now, understanding how it enhances risk, the risk side is quite simple in my view. If I look back over the 25 years that I've been managing money, the biggest mistakes I've made have all involved companies that had big G flags. They had big governance issues, or there was another one of those E and S that really was troublesome. So this ESG analysis and sort of integrating it into research just adds another level of analysis and gives you a different perspective, which will hopefully reduce the number of research mistakes you make. On the return side, we like to think that you can make money out of sustainability. We did so with the gentailers, the generator retailers in New Zealand. Quite a few years ago, we sold all the Genesis, which is a coal-fired generator, and put that money into the renewable energy generators. The idea was that coal was going to become troublesome when carbon prices started to increase, and that investors would also value the more sustainable generators. So we made a lot of money doing that. So that's a way that you can actually make money out of ESG. So with our sustainability, focus is really on how do we enhance risk-adjusted returns. I should add that we have made impact investments. We were the first KiwiSaver provider to invest in community housing. We backed a couple of projects that the Salvation Army had developed. Great projects, great product, and the tenant was the government, a 25-year agreement with the government. So we were looking at earning a yield on the debt that we were providing them. That gave us a nice spread over risk-free. When we had government, the first risk was government, and the second was the Salvation Army if the government did bail on the development. So we're plenty happy to invest in impact investments as long as they're providing our clients with a fair return. Finally, we've got Michelle right on the left-hand side. Michelle's a really experienced ops person. She's really important to the team because she can take some of the admin type activities off us. So this next chart gives you the performance of the Focused Growth Fund for the last 3 years, and then the underlying wholesale funds that feed into it. So we start at the far right with the Focused Growth Fund. That's a post-fee but pre-tax return. So the Focused Growth Fund has outperformed its benchmark on a like-for-like comparison over the last 3 years. The other 5 funds are the underlying wholesale funds, as I sort of mentioned before. They're all 3-year annualized returns as well, apart from Thematic. Thematic was actually set up a little under 2 years ago. And so they're 2-year returns that have been annualized. So I guess the first thing to notice is that most of those portfolios have done pretty well. Ayrton's fixed interest portfolio, 80 pips in front, is not bad for a fixed interest portfolio. Australasian fund, 4.5%, great. Two global funds also, great alpha. Managers is the one sort of soft point. So I might just give you a feel for why the managers funds lagged before moving on. The managers fund is managed by Sam, one of the two co-founders, and he is interested and focused on making sure that the retail funds are positioned to reliably perform. Now, one of the things that he does to ensure that or to help that is to position the managers fund, and so it's a good complement for the global direct and the thematic fund. Both of those two funds are overweight US equities. Now, for the last 3 years, that's been great. Just recently, it's been a bit it's sort of reversed, but those two portfolio managers had an overweight to US equities, and to sort of counteract that and to reduce that, Sam has been including funds in his managers fund that have less of a weight to US, and to sort of just reduce that skew that we've got to the portfolio. Over the last 3 years, US has done well. Having that bias has not worked too well. The second thing is that fund has private assets. Private assets just haven't kept up with the hot global listed markets, and so the managers fund is behind the benchmark. Before I move on to the next slide, it's probably a good thing to point out that each of these portfolios is managed with a different style. Generate hires portfolio managers that are experienced, well-seasoned investors that have a technique, have an approach. We do that because then we can combine different approaches and different techniques and start with a portfolio that has a mix. We think that approach will provide more reliable returns than if we had one religious approach that we're applying across the whole portfolio. The reason being that different market environments favour different approaches. And so if we can spread out that approach risk across a number of different approaches, we're hoping for more consistency there. Hopefully that makes sense. This chart shows the asset allocation of the Focus Growth Fund over the last 3 years. If it's on a relative basis, and so if the asset class line is below zero, we're underweight it. If it's above zero, we're overweight it. So the first thing to note there is that we haven't taken any large asset allocation decisions. It's all relatively close to zero. We're not looking to add a lot of value from asset allocation. Our focus is adding value by security selection. Again, it gets to this trying to reliably add value. With security selection, you're adding value across a large number of decisions. And so if one decision doesn't work out for you, hopefully there'll be others that are offsetting it. With a tactical asset allocation value add, you've only got one or two real decisions to make. Am I under or overweight growth? Am I under or overweight domestic or global within that growth? They're the two sort of key decisions that you're making. So you've got a few decisions you're making. It then really makes those decisions crucially important. And so what we do is we don't take large asset allocation positions. We try and add our value via security selection. We can see there we have taken some positions. A good example is the Australasian, the domestic equities. Up until August 22, it's basically on zero, close enough, and then it drifts downwards. So what happened in August 22 is we had the reporting season for the companies reporting their June year-end or June half-end results. A lot of them came out and talked about how tough the economic environment was. At the same time, we had a number of economists that were cautioning the fact that the New Zealand economy was in for a tough time. So we had a setup where it looked like, for the global share market, it looked like earnings growth was going to be difficult. At the same time, we had PE multiples at highs. They were 5-10% points above the global comparables. And so what we decided to do was to take weight out of the domestic market and put it into the global market. Looking quickly at the global line, that's probably the other one that's interesting to look at. You can see there that it's also moved around zero. The focus when we talk about global shares is the US economy and US valuations. That makes up 65-70% of the index, and that really does need to be a focus. And where you can see it coming into action is in the sort of the second half, or the second quarter of 2024, when we started to take weighting out of our global equity position, started to move down to benchmark and then modestly below. That was running into the US election, when it became less and less certain who was going to win the election and how it would turn out. As soon as it started to become more and more obvious that Trump would win, we started to put that weight back in. So you can sort of see there what we were doing was we're just trying to manage risk with the TAA. We weren't looking to add lots of returns. It was more a risk focus that we had there. It's probably a good time now to talk about the current situation and how we're positioned with this slide. So the sell-off has been severe. It's been rapid. As you all know, the US market has been in an oversold position for the last couple of days. It's been one of the hardest sell-offs that I've seen in my career. To understand why it's been so dramatic, we need to look back a week and talk about what the scenario was and what the setup was for the market a week ago, pre-Liberation Day. So pre-Liberation Day, there was only one strategist that was talking about a US recession. It was the guy from BCA. He's been talking about it for the last 6-12 months, and quite frankly, looked like he was just going to be wrong again. The US economy, the US consumer remained strong. Employment was growing at above expectations. It looked like the Federal Reserve had really pulled off the almost impossible and achieved a soft landing. So we had a pretty good setup economically for the US share market. At the same time, people were enthusiastic about AI, and so the market was slightly expensive. Liberation Day changed all that. The level of tariffs that Trump announced and the waffly calculations that he's used to come up with those tariffs really start to question what the growth outlook looks going forward. A good example was JP Morgan, who turned around in the weekend and put a 60% probability on a US recession and a 40% probability on a global recession. The basic logic was that if these remain in place, we've got a recession, but it's impossible to know whether that will occur. So at the moment, we're sitting looking at either a bimodal or a binomial outlook. If the US softens its stance, or Europe and China do some sort of deal with the US, and the tariffs aren't as implemented in the sort of draconian levels that they're talking about, then maybe we can escape a recession. But if no one blinks, we've certainly got a recession on our hands. So if you have absolute certainty that China and Europe aren't going to blink and the tariffs are going to get implemented the way that they've been explained, you should be selling today. The problem is that Trump is an unpredictable actor. It's impossible to know what will occur, but the best guess has to be that there will be some negotiation, and the current proposed level of tariffs won't be implemented, or at least for an extended period of time. So how have we positioned the funds given this high level of uncertainty? Well, frankly, we've gone back to benchmark. At a time when it's impossible to forecast what's going to go going forward and build conviction, is a good time to have a neutral position to global equities. Now, I've included a chart that we'd like to use to really sort of sum up our sort of point of view when it comes to these sort of situations. So this chart uses Shiller data. Shiller provides data for the US stock market going back to 1871. So quite a long period of time. I think we can all agree 150 years is pretty impressive. What I've done is I've taken the 10-year rolling returns. So if we've got 150 years of 10-year rolling returns summarized in this chart. What you can see is in a large number of occasions, the returns have sat between 5 and 15%. Sometimes they sit below 5, sometimes above 15. But normally, you can get a pretty reliable type of return even out of shares if you've got a long enough time horizon. There are a couple of occasions where it's been negative, but if you look at the proportion of occasions, then it's not all that often. And one quote that we like to roll out at times like this is the Buffett quote. The founders love Buffett. Berkshire Hathaway has been a key part of the portfolios right from the day dot. And the quote is, in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions, and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow Jones rose from 66 to 11,497. Massive returns, a lot of reasons why things should have got skittled. So when we sit today and look at how bad the environment looks, we have to keep in mind that there will be a solution. Things will get resolved, and over the next 10 years, you need to be invested in equities. I'll move on now and talk about some of the different wholesale portfolios, and so you can get a feel for how we've put together the Focused Growth Fund and how the different managers have got completely different approaches. So a good one to start with is Nathan and his thematic fund. Nathan starts with a top-down approach, which is relatively uncommon in New Zealand. He works out themes, so areas of the economy or particular types of companies that he thinks are going to enjoy tailwinds. A great example is the travel and leisure theme. Going out of COVID, he developed the travel and leisure theme to take advantage of the fact that people had been locked away. When they were allowed to travel, they would travel, and those stocks would enjoy some strong tailwinds. So he developed that theme, then he found some stocks to take advantage of it. I should note that this theme is a good example of how the themes don't last forever. At the moment, that theme weighting has been wound right back. He's pared it back, and that's because that whole post-COVID travel boom looks like it's coming to an end. The forward bookings that the US airlines are talking are a good example of data points that are saying that the travel and leisure boom is over. Now, it doesn't have to be a particular part of the economy. Another theme that I've got up there is maturing platforms. So they're platforms that for a long period of their lives have been going after growth and focused on growth rather than cash flows and earnings. Well, those companies have gone through starting to mature, and so now they're focused on making money. So the idea with that theme is to take advantage of the re-rate of those companies when they start to produce strong earnings. If we move on to Warwick's fund, hopefully. Warwick manages the Global Direct. Now, as I said before, Warwick doesn't work for Generate, he works for Compound Global. He uses a more typical approach, an approach that you've probably heard a number of times before. He likes good quality businesses, but he doesn't like to pay over the odds for them. So I would sum him up as a more of a value than a quality investor, frankly. He likes to buy businesses, good quality businesses at cheap prices, but he's also happy to buy average quality businesses businesses when they're great. A good example of that is that he's owned the airlines. He's owned oil companies at different points in time. Moving on to the Managers Fund. I think I've talked a bit about this. This is the fund that Sam manages. It's made up of global or listed equity managers as well as private equity. So you can sort of see there T. Rowe Price, Tiara Mairangi. They're the sort of listed equity managers on the slide. Sim is a very large US property investor that's moved into infrastructure about a decade ago. They've got a great data center business that they've helped found. That they've also got a large renewable development that they're involved in. So we're invested in their fund. Nova is actually the data center. So we've co-invested with Sim. It's an agreement that we like to do with our private equity managers to try and reduce the fee drag from private equity and also tilt the portfolio in the areas that we like. Finally, we've got Icehouse just on the slide. Last but not least, is Australasian. That's the fund that Andy and I manage. I was going to go into a bit of detail of this on the stocks, but I've noticed the time, so maybe I will if there's time. But Andy and I like companies that have got forecastable earnings, and so we like the sort of infrastructure, the generators, gentailers, etc. We've got on the slide Westpac. It doesn't fit into it, but it's a good diversifier. So I'm going to pass back to Katie now, and if there's no questions, I'll go through some of the stock stories we've got.
Yeah, thanks, Dan. That was a really good summary of your funds and Generate and the portfolio managers, and really good learning for all of us on the call. I just want to, I'm sorry I didn't say beforehand, if you do have any questions for Dan or for Jonathan, please just pop them in the Q&A box and I can read them out. I did have a quick question just to kick things off for you, Dan. So just wondering, just typically, like, how many securities are you holding in the fund at any given time? And primarily these are equities, presumably.
Right. So on a look-through basis, you're looking at 500 different securities. Because we've got these underlying managers, it does sort of spread it out. To give you sort of a slightly more fulsome answer, the thematic and the global direct will all each have 50 securities, would be a good starting point. Our fund's a little bit more compact. It's less than 30, but then you add all of the stocks that T. Rowe have got, etc. You do get to a list of 500.
Okay, that's good. But then in terms of, completely understandable that you guys are sort of hugging the benchmark at the moment as things are really uncertain. I guess what would give you comfort to jump back in, and sort of what are you looking for as a portfolio manager?
That's a great question. That's an excellent question. It's the catalyst. Basically, we're looking for the announcement that someone's done a deal or that the tariffs aren't going to be as bad as expected. That should see a bit of a bounce back in markets. We could still sell. I wouldn't rule out that. It would be a really, really tough decision, but we could trim slightly if the news from the negotiations is horrendous. It's looking unlikely. That Europe looks like it'll probably do some sort of deal, and so that will just be down to a China-US trade spat again.
Okay, great. I don't see any questions coming through at the moment, so I think we'll wrap it there. Really appreciate you taking the time, especially during these busy times. And thanks so much for joining us.
Thanks for your time.
Okay, next up we have Jonathan Windust. Jonathan is the portfolio manager at Milford, managing the Milford Active Growth Fund. So appreciate you being with us, Jonathan. Again, any questions, please pop them in the Q&A box and we'll sort of leave the last 5 minutes to answer those, but I'm just going to hand it over to you, Jonathan. Thanks so much.
Just unmuting myself. Hi, everyone. I thought I'd just give a quick overview of the Active Growth Fund. We're a little bit different to other funds, and in terms of our objective is more sort of absolute. We're trying to get a return of 10% per annum over sort of longer term, sort of 7-year hold frames. What we mean by absolute is we're investing where we're rewarded for risks, and not because something's in the market index, or a share market index. Our portfolio is very active, and we do look quite a lot different to share market indices. We're active, and we're very active, so we will move the fund around, and we'll move to where again, I'll keep talking about this, but we'll move to where we think the best opportunities and the best risk reward is. This fund is predominantly direct securities that I'm selecting with the help of our very big 40-odd investment team here, but also about 10% of it's outsourced to other managers at Milford. That provides a bit of diversification for the fund. It is a growth fund, so we expect to average around 80% in shares over time, and the rest of the portfolio is predominantly cash and fixed income, and within that fixed income, it's predominantly credit. However, I have bought New Zealand government bonds, and I think that's pretty much the first time I bought government bonds for the first time in 8 years, so we can talk a little bit about that. How we add value, stock selection is key, so I mentioned very large team here in New Zealand and in Australia. We are sort of bottom-up investors. We are focused on risk and reward. What we're really looking for, we try and keep it reasonably simple, but companies in growing markets, strong competitive positions, good management teams, and where valuation makes sense. Another important part of value added is strategy. So we're very active on strategy and changing the portfolio. So if we can't find attractive things, as I said, we'll move to cash, we'll move around, and we'll talk a little bit about the current fund positioning. Risk management, something we also take very seriously. We do try and predict the downside, and we can do that various ways. The simplest way through cash, but we do use options and derivatives and currency as well to manage the risk of the portfolio, and we're very active in that. Another thing that we do, I think that we do well, is we're very flexible, and we can and will move. And I sort of talked about at the start, not tied to any one benchmark. We're just looking for good opportunities and combining those opportunities into an attractive portfolio. And fixed income, we are very active in fixed income, so we do move the duration of the portfolio up and down quite considerably. So we'll even go negative duration if we think the risk is rates are going to rise, and that will hurt share markets and bonds. So the two are positively correlated. We don't want to own fixed income. At the moment, the opposite is true. We think, although it wasn't overnight, but we think that if growth slows, then yields will come down, and that should provide some offset to the share markets at the moment. So adding all that up, we think over time we can generate stronger returns with lower risk. So again, that objective, trying to keep up with the market when it's running strongly without taking too much risk, and then outperform when we get choppier times. I think one of the questions was recent fund performance. So the fund's done pretty well so far year to date. I think the fund is down about 2.2% as of the 4th, and that compares to our market index, which is just a composite of the various market indices, of down around about 6%. And from the highs, the fund's down around about 6% compared to the market index is around about 9%, and global markets around about 14.5%. So what are we doing and seeing at the moment? Obviously it's a very uncertain time. Part of our process is we sort of do a quarterly strategy meeting where we get together and we sort of take a step back and look at the economic environment. And our process, we call it the 5 Ps, but we look at sort of 5 main drivers of the market. So the first of those is price, so valuation in other words. And the valuation of markets, it does vary quite a bit between markets, but the biggest market, the US, valuations are were undoubtedly high. So at the high end of PE ranges, and weren't really providing a great risk reward. We were finding attractive opportunities in other markets though, where valuations were more attractive, and that was Europe. So we've had an overweight to Europe for a reasonable time period, and that started to pay dividends this year as the markets turned away from US exceptionalism to favouring Europe more. So that's working well in the portfolio. Another one of our P's is policy. So yeah, how is policy impacting the markets? And at the moment, tariff policy is the worst possible policy you can have, I think, or we think. So yeah, tariffs are basically trying to create higher prices and lower growth. So yeah, the policy doesn't make much sense to us, and hence we have been very, very cautious in the funds. And the other part of policy, monetary policy, I think the Fed, and we'll focus on the US because everyone does, is in a pretty difficult situation. So in previous downturns and COVID, GFCs, you've had the Fed being able to come in and really react and print money and cut rates very quickly. However, at the moment, we think their hands are tied, just given inflation, and tariffs are going to exacerbate that inflation. And even before tariffs came in, we were of the view that inflation was going to be sticky in the US. Fiscal's also in a bit of a bad situation in the US. They are debating, there were tax cuts due to come off, $4 trillion worth of tax cuts that Trump campaigned on keeping. So they have to find ways to fund that. They may fund it with the easiest way of all, which is just change the rules. So we'll see. But before that, there is a risk in whether they can just change the rules or whether they're going to have to find savings in areas like the healthcare market. So your policy is very bad at the moment. Another one we look at is profits. So growth, and as I sort of talked about, the profit outlook and the growth outlook is deteriorated quite significantly. Even with the tariffs, even before the tariffs got announced, a lot of uncertainty, both consumers and businesses. So businesses aren't going to spend, they're not going to commit to very expensive IT projects. So yeah, we think the profit outlook is pretty weak, and we're going to come up to earnings season very shortly, actually, in the US. We've got the banks reporting on Friday, and then a couple of weeks, all the Magnificent Seven. And I think it's going to be very difficult for those companies to issue positive guidance. The results themselves may have a little bit of weakness, but yeah, most importantly, the guidance I think will be relatively weak if they give any at all. So that's a pretty bad backdrop for profits. The fourth of our P's is positioning. So we think investors are relatively fully positioned, and in particular, retail investors who have just seen share markets keep going up and up for the last few years. So we think, there's potential for people to sell. What we saw actually was in the first few dips, retail actually came in and bought quite aggressively. So on sort of Saturday morning or Friday US, we had one of the biggest volume days ever. So we still think a lot of the speculative positioning has wound out, and potentially some of the speculative or short-term money is probably even short the market now. So that could potentially cause a spike in the market. But overall, we think the positioning situation is still pretty difficult. And then the last of our P's is potential risks and potential opportunities. Risks are still high, very high. At least the risks are known in terms of the tariffs. Well, they're partly known. There's still a lot of uncertainties around those. But we are seeing a lot of potential opportunities. So that's the biggest positive we see at the moment. So lots of companies are getting sold, potentially when they shouldn't, because they're just getting caught in the crossfire. So an example of that is some of the defensive companies, and we own a lot of those at the moment. The portfolio is tilted quite defensively. Those have started going down as well. So those with risk off and potentially lower interest rates, those fundamentally should be increasing in value. So we've been able to put money to work in those, and just a few sort of oversold opportunities around the place. So yeah, how are we positioned at the moment? So towards the start of the month, we were more defensively positioned. The fund had sort of close to 60% in shares. And we have some derivative options to protect against market falls. Since then, we've added a bit back to markets, and particularly we bought the UK market. So at this point in time, we're closer to 68% invested in shares. However, I mean, that can change pretty quick, and yeah, we'll take advantage of the ups and the downs, but we're likely to stay around that area. If anything, I think if the market rallies for here, we'll start to reduce and take some risk off and out of the portfolios. The other really important thing about positioning is what type of companies we're invested in, and at the moment the portfolio is very, very defensive. So we're in more defensive sectors, such as utilities, which I talked about. So Contact Energy has always been a favourite for the fund, very high dividend paying company, but also some of the European utilities. So SSE is a big holding. It's similar to a Contact, but in the UK, trades at a very low valuation, around about a 10 times earnings multiple. Some of the regulated utilities, so we've got National Grid in the UK and the US, Duke Energy in the US, and then we're invested in reasonable weight in consumer staples. So the UK supermarkets, Tesco's and Sainsbury's, and also Marks and Spencer's, which is a bit of, I guess, it's fairly non-discretionary, lower end sort of retail in the UK in terms of the apparel part of its business, and then sort of a quite a nicely positioned food offering, which is benefiting from sort of a shop, people with sort of tight budgets moving out of from going out and eating at home. So that's working quite well for them. So the mix of the portfolio, and telcos is one of the other sort of defensive sectors, and airports, another big holding. Not Auckland Airport. The fund hasn't held Auckland Airport for a reasonable amount of time, even though it's a big weight in the New Zealand index. We just think that it's very highly valued. We've got quite a decent holding in Spanish airport operator ENA, where Auckland Airport was offering a 2% free cash flow yield. ENA was offering a 7% free cash flow yield, with a lower cost of capital, being in a lower interest rate environment. And Spanish traffic has turned out to be much, much better than New Zealand traffic, where we're still struggling to get back to where we were. So that's the sort of sector positioning. Geographic positioning as well as defensive, as I talked about half of our global shares. So the fund has about 45% in global shares at the moment. About half of that is in the UK market, where we see much more attractive valuations than the US. Now, the UK is not without problems. I was over there visiting 2 or 3 weeks ago. So it's in a difficult situation, but it is so bad, and everyone knows it's bad, and we think it's hard for it to get worse, and we're actually optimistic it will get better. And these tariffs, if anything, are potentially a positive in terms of, we think, it may be deflationary as people divert goods. We send our wine to the UK rather than sending it to the US. We send our meat, etc. So that may provide the opportunity for the Bank of England to cut. So we think actually, the UK getting bad could actually be better for us. Reasonable weight in UK and European shares. So we've got a few European shares as well, which we can talk about if we have any questions on that. New Zealand's about 10% of the fund. We've been a little bit light in New Zealand for quite a while, just given the weak nature of our economy. What we do own in New Zealand is very defensive. So as I talked about, the utilities, Contact Energy, Mercury Energy, etc. So we think New Zealand's a good place for income, but very difficult for growth. And that the companies that are growthy typically trade on very high valuations, and we can find those more attractively overseas. So the last question on the list was client takeaways. For active growth in particular, I mean, we're biased, but we think it's a great fund. We can get the upside. We can have lower drawdowns in markets like this. Another stat, since the market peaked on the 18th of February, the market index, what would the benchmark or the composite indices, if we were to benchmark that the fund was invested in, has fallen about 9. MSCI Wood on New Zealand is down 14.5, and the active growth is down 6. So we've only fallen 2/3. So that's a takeaway. We think Active growth is well positioned, the active management, and particularly for those clients that have an aversion to losses, which we all do. And I think this environment is setting us up pretty well when markets do recover. Often we find when markets fall, the market's pretty indiscriminate. It sells everything, whether it should or shouldn't. As I said, some of the defensives getting sold. So we think that is actually creating opportunities. So for more medium-term investors, we think this is a pretty good opportunity. What's going to happen in the short term, it is very difficult to know because it comes down to Donald Trump and what mood he is in. But from what we are seeing, they seem pretty determined to keep the tariffs on. So there's going to be some negotiation, but we think any major deals are unlikely anytime soon. So hence we're still cautious. What we've done to participate if the market does go up. So we have sold some options, some put options in the fund, and that generates premium for us. And we're selling those a long way below the market. So if the market falls, we still generate that premium. And the value of those options that we've sold goes down so we can buy them back cheaper. The market does fall. We're buying at levels that we think we'd be happy to be buying. That's a very quick run through of the Active Growth Fund. Open to any questions.
Yeah, thanks. That was a really good rundown and so interesting to hear everything that you're doing. And you guys are probably quite a bit more active than a lot of managers at the moment. So it's nice to see you're staying on top of things. We have a question that's come in from the chat. So just asking if the US market is looking a bit more attractive given the recent sell-off.
There are parts of the UK market that are attractive.
US.
Yeah, US market. Yeah. I mean, as valuations fall, things look more attractive. But the risks are really high around the tariffs and the lack of policy response. So we're pretty cautious of the Mag 7, which make up a large part of it. We do like Amazon and Microsoft for the cloud theme, but we think Meta, Tesla, Apple, Nvidia are still relatively highly valued relative to the risks, so don't hold a lot of those. But there's certain parts of the market, as I talked about, some of the more defensive areas that we think are attractive at the moment. But it is. It's not an easy. And if we knew what tariffs were going to do, it'd make things a lot easier. But that's where we are.
One of the things that differentiates your fund from other funds in our KiwiSaver GoalsGetter scheme is your use of options and derivatives. And you sort of mentioned at the end, talking about selling some puts recently to hedge the portfolio. Can you just give a little bit more color on that? And sort of how you're using some of currency and derivatives in the portfolio and some examples of that for people to understand?
Yeah. So options are sort of like insurance, and sometimes insurance is really cheap and we buy it. So for a large part of last year, we were actually buying call options, so the right to buy the market if the market went up. And call options were really cheap. That helped us keep invested with the market. We were actually sort of selling put options then to sort of give us free options. So that was a much better way of getting market exposure. You get the upside without the downside. What we've done more recently, however, though, is that insurance is really, really expensive, particularly in the US. So instead of buying the market, so at the moment, Active Growth Fund, it was sort of, I guess, sort of close to 20% of the 20% less invested, but we're happy to buy the market if it fell 10%. I wonder if there's an option here to tell you what premium you're getting paid. But yeah, we're selling someone else. Someone else has got the right to sell us the market at a lower price, but we get paid a handsome premium to that. So yeah, last night we did some crazy ones. We sold put options that were sort of 15% out of the money on the Nasdaq, and we got paid 2.5% for that. So yeah, the market falls 15. I think we'll be very happy to be buying down there, and we're underweight all those technology companies anyway. So we're generating a nice premium for doing that. We did the opposite on the UK actually, because UK, we have got a decent position in the UK, and UK volatility, because it's traditionally a lower sort of volatile market. So the price of puts in the UK was very cheap. So we actually purchased options on the UK. This was when I was in the UK a few weeks back. But yeah, those have paid out handsomely because the market has fallen very fast. But that was pretty cheap insurance at the time, but very expensive now. So yeah, we potentially sell those options back out to the market again. So yeah, it really depends on the price of the option or the volatility that's used to price them.
Okay, thanks. That's helpful.
Yeah, I mean, the VIX, we were selling options at volatility of 50%, and normally, so the ones we bought were 12% in the UK. So yeah, very, very big moves and volatility caused by a lot of sort of fear out there in the market, I think.
Just want to pivot to geographies. So you mentioned global's 45% of the portfolio, and at the moment, half of that is the UK.
UK and Europe, sorry.
And Europe, sorry. So you mentioned some ideas, some positions in Spain, a little bit of New Zealand at 10%. But can you talk a little about if you're looking in any of the emerging market economies, if you're checking on names in China, or does that not really measure up on your policy P? Like, how do you look at some of those markets?
We don't spend a lot of time investing in emerging markets. Stephen Johnson, who looks at the aggressive fund here, he managed emerging markets for a while. George, another one of our team members, has done emerging markets, but the risk reward is not great at the moment. And we're finding, decent risk reward in more developed markets. So it's not something we've done. A few years back, we had some Alibaba in the portfolio, and then the Chinese just changed the rules. They basically said you're not allowed to make so much money. So I think China's not very investable, and even more so at the moment. So it's very hard for us to get comfortable with the risks investing in those markets, even though we do have portfolio managers and team members who've worked in emerging markets. But they're not encouraging us anytime soon to go look at those.
It seems like there's a lot of opportunities elsewhere where you're a lot more comfortable. Quick question on turnover, sort of on average, how long are you holding securities in the portfolio?
It's not something I pay too close attention. We do analysis on a company, we decide what we think it's worth, we buy it. Sometimes it'll go down, sometimes it'll go up, sometimes you hold it for a long time period, sometimes it'll go up and you'll get sort of 10-15% in 2-3 weeks. So we're generally looking to buy things for longer holding periods until they realise where we see the value. So it really depends. But if it hits our price targets, we'll sell and try and find something else. If we still think it's attractively valued, we'll hold for long time periods. But we're generally trimming. We have a portfolio of things we look at, and we're just generally increasing and decreasing the position sizes depending on sort of the risk reward.
Right. All right, I don't see any other questions coming into the Q&A box, so I think we'll just give everyone back 5 more minutes of their lunch hour, but really appreciate you joining us, and good luck continuing to manage these volatile times.
Great, thank you for your support.
Thanks, everyone.
Bye.